In June 2023, Congress passed legislation that suspended the government's debt ceiling until January 1st, 2025. That suspension allowed the government to continue borrowing without being constrained by any borrowing limit. On January 1st, however, the debt ceiling came back into effect. The new debt ceiling was set at the level that government debt outstanding reached on January 1st. That means, starting yesterday, the government will be unable to increase its debt until Congress passes a new law that raises the debt ceiling. This situation could turn into a serious problem, and fast. On December 19th, 38 House Republicans defied the demands of President-elect Trump by voting against a bill that would have raised the debt ceiling. These deficit hawks want Congress to enact spending cuts that would sharply reduce the budget deficit before they agree to raise the debt ceiling. Republicans have only a razor-thin majority in the House. If only a handful refuse to vote to lift the debt ceiling, the government will face an immediate funding crisis. If not resolved quickly, this impasse has the potential to undermine market confidence and cause a significant stock market sell-off, even before the new administration takes office. There are a number of reasons for this. First, the failure to get the debt ceiling lifted quickly could undermine confidence in President Trump and in his plans to cut taxes, resulting in a stock market sell-off. Second, the inability of the government to borrow would mean that the Treasury Department would have to put in place emergency measures to prevent the government from defaulting on its debt. These could include delaying government payments that don't legally require immediate settlement, such as certain federal vendor payments or grants to the states. Such spending delays could have a negative impact on the economy and undermine investor confidence. Third, a protracted battle over lifting the debt ceiling could also result in the credit rating of the United States being further downgraded. While a credit rating downgrade might not produce a stock market crash in and of itself, it would contribute to an erosion of confidence in the outlook for government policy, the economy, and asset prices. This video is not going to focus on those potentially negative consequences, however. Instead, it's going to discuss how a debt ceiling standoff could actually boost asset prices during the months ahead. Here's why that scenario could play out. The debt ceiling will prevent the government from borrowing additional funds. Therefore, the government will be forced to run down the funds it currently holds in the Treasury Department's account at the Fed, the Treasury General Account, or the TGA. Luckily for the government, there is a great deal of money in the TGA, $735 billion as of December 25th, as shown here. Spending those funds will enable the government to keep the lights on, and more importantly, to avoid defaulting on its debt for at least a few months more. In addition to that benefit, and the thing I would like to focus on here, when the Treasury Department spends the money in its TGA account, that adds to the level of liquidity in the financial markets. And increasing liquidity tends to cause asset prices to rise. This requires some explanation. What is the TGA? The Treasury Department